Good morning, everyone. Welcome to this update for global markets for the 19th of June. And there's not going to be a lot happening next week more important than the vote in the UK referendum on Thursday. That really is the key focus for markets. It's going to be the main driver for markets. And I suspect that we're probably just going to see markets in limbo prior to that outcome. This will be a bit of a briefer video, but nonetheless one that's really important, particularly for precious metals, because I think we're just continuing to see evidence that we have one very, very powerful bull market on our hands, and it really is just a matter of not where it's going, but how do we actually play it. So let's get on and have a look at what's transpired during the last week. American stocks, the S&P was down 25 points on the week, but it did recover off some lows. So a lot of that was about fears over what would happen with the UK referendum vote if the vote was to leave, and the volatility that would create in world markets. And as I said, the total focus is just going to be on this vote. There are also, however, some spreading concerns. So as a separate issue and as a longer term issue, there certainly are some spreading concerns about the health of European banks. And we're seeing that through a number of indicators. Not the least is the share prices of European banks, which are just an absolute disaster. I mean, they must be just about one of the worst asset classes in the world. And certainly that's not going to be a good scenario in the longer term. So that's certainly one to watch. And I think that's also perhaps part of the reason why we're seeing such unexpectedly strong support for gold. Now, over the last couple of weeks, I've given you some short-term supports in the S&P. They were just that. They were quite short-term. They were broken during the week, but the market did manage to fight back on Thursday from lows, and again on Friday night. So there's still quite obvious buying support there, and we remain stuck in this range. The US dollar index was slightly lower on the week, but looked really not far off flat. And we just saw a lot of volatility in all currencies during the week. So technically for the S&P, we've now got a bigger range that I think we can look at, with supports down at 2020 and also resistance, of course, at the all-time highs at 2130. So let's take a look at the S&P index. So we'll start first of all. Let's have just a quick review of the big picture. So this is the monthly chart looked at over just about 20 years. You can see we had what looked like it might have been a change of character through August and then January, February of this year, threatened to roll over into a bear market, but then rapidly regained its footing again. And so, as I've been saying now for some time, you've really got to look at this period that really started in October of 2014 as potentially just a consolidation. We've had a massive run. A lot of people are assuming this is a top. I don't accept that premise. I'm not saying that it's not a top, but it could equally be a consolidation before we get another run. And because this was such a massive bull market, those sort of very substantial runs in both time and also in price can then be followed by extremely long consolidations that can last for anywhere from 1 to 2 years. So this consolidation started in August of 2014. It's possible this could roll on for some time yet, and then still resolve in another leg higher. That's entirely possible, but I think this depends on a lot of things. So here's the S&P. Here's the bottoms that have been formed here since March of this year at around 2020, and of course the all-time highs up here. And until the market indicates otherwise, you've got to assume that we're going to remain within this trading range. Don't try and anticipate or second guess the market because you are likely to come off bruised, I suspect. Turning now to the Australian market, the Aussie dollar was again very volatile. It was all over the place, finished at 74. But look, we've got variable drivers, and the Australian dollar is not just responding to changes in the US dollar. There are other, obviously, variables weighing on the dollar as well. And it's also not just commodity prices. There's been several days where the Australian dollar has moved quite significantly, and the US dollar index and commodity prices didn't change all that much. So it's a real mixed bag of what's driving the Australian dollar. As I said last week, I believe the trend, or definitely the trend, is still down in the Australian dollar. There's no question about that. And I believe that fundamentally we're looking at prices in the 60s and possibly even the 50-cent range. So whatever happens in the short to medium term, you've got to assume that the Australian dollar is still headed lower. And we'll take a look at that in a minute. The index down by 150 points, pretty bad week. The banks were the main drag. The major miners were down a little bit, but it was certainly the banks doing the damage. So the overseas interests obviously continuing to sell down on our banks. So let's just take a quick look at those couple of charts. We'll look at the US dollar index. So here's this key 92-cent level. We've been quite volatile in the last couple of weeks, as you can see, but really it's more of a sideways pattern than anything else. This is the Aussie dollar. Pan back, there's the big picture downtrend. So no question, we're in quite a decent downtrending channel. It's not showing any signs of coming out of that channel. The price is a little bit above the midpoint. Could go either way. We've probably got a peak here at the moment around the 77 mark, but equally the bottom of the range would be down in the low 60s. So it is quite a broad range. Turning to the ASX 200, just for reference, 5400 continues to be a ceiling for the Australian market. We've got a low down here around 4700, and we're sitting just above the midpoint. So it's really just been a big sideways consolidation since August of last year. So nothing really to report out of the ASX 200. Now, I've had people say to me over the last few weeks that, gee, the Australian banks must be a good buy at this level. And maybe they are, maybe they aren't, but I'd really caution people about making that assumption, because that assumption is based on past history. The banks have done well, not so much over the longer term, and the banks have really gone nowhere for about since 2007, so nearly 10 years. What I think lasts in people's memory is the fact that they've done fairly well over the last 2 or 3 years. But those conditions are changing, and changing quite rapidly. So I don't know where the Australian banks are going, to be honest. They're not something that I feel that I can get overly confident about, because their share prices are dependent to a fairly large degree on what overseas interests are doing, and who knows how they're making their decisions. So I can't get excited about the Australian banks at this level, and I would just caution you about just assuming that because they've been good means they're going to be good in the future. Now, turning to precious metals, of course, gold had a volatile week, but it was higher by $24. We're just getting this continuing amazing strength. Now, there was some very large volatility late in the week. Gold shot up above 1300, got up to about 1313 at one stage, and then with the very tragic death of that UK MP, we saw the gold price come off quite sharply, but then recover to finish basically right at 1300 again. So a lot of noise, but not a lot of net movement when it all comes down to it. There is still proof of surging investment demand. So as I've been explaining, you've got two parts to the gold market. You've got the speculative area where people play with the futures market on very high leverage, and that is an area that's quite hard to to make any conclusions about. And then, of course, you've got the investment side of the market, which is the section of the market that will fuel and sustain this bull market. And there is plenty of proof of continuing surging demand, real money going in, buying real physical gold, not just playing around in the futures market. It is unusual to see the strength at this time of the year. Seasonally, we would have expected weakness related to cultural, the wedding season events, and also harvest seasonality. This is the weak time for gold demand through India and China, but it would appear that seasonality is just being swamped by investment demand because of fears of lots of different things. Basically the financial world that central banks have created for us, that they've manipulated and distorted. And I think it's really dawning on people now the seriousness of the situation that the financial system finds itself in. So we're seeing most unusual strength at this time of year. Now, I've also been pointing out to quite a high gold to silver ratio, which is still sitting somewhere between 70 and 80 to 1. And if you look at the research on this, a very high gold and silver ratio is very typical of the start of a bull market. Gold tends to go first, and then silver follows later. And so because gold outperforms silver in the early days of a new bull market, then we tend to see that gold to silver ratio go up, which is exactly what's happened this time. So again, this is just one more piece of evidence. It's building an enormous wall of evidence in favour of a major bull market. Now, turning to precious metals stocks, in the very short term, it's hard to be bullish when stocks have run up by 100 to 200% in the space of 3 or 4 months. It's really hard to be bullish. However, and I must add, there was quite a large reversal candle on Thursday when the price of gold dropped, and we'll look at these charts in just a minute. But that then reversed, and we saw some strength come back into the market. So it was really only a one-day event. But look, gold stocks and silver stocks continue to defy the headwinds. There is seasonality, there is the dollar, there is a whole range of reasons. There is very, very long positioning in the futures market, which typically leads to reversals. There's 5 or 6 reasons why gold stocks shouldn't be doing well at the moment, but they are. And that in itself is a real sign of strength. Now, I've looked back in history, and there are some precedents for up to a year of uninterrupted gains. So this bull market started in late February. And so the assumption is that after 3 or 4 months, we should get a correction. And that's just the natural way that we think, because that's what happens with most markets. But when you actually look back over the last 50, 60 years, there are previous precedents for gains of up to 9 to 12 months with virtually no correction at all. Just little pauses, and then it's off again. So I'm not prepared to discount that this market could just continue to go up from here without any further downside. It's just an area where you've just got to be a little bit careful. So let's have a look at the gold side of things. We'll look first of all at the weekly chart. And I'll just zero in here and look at this first bit. So we've risen from this low point here in late December. And if we put a Fibonacci scale to this recent peak up here a couple of weeks ago, then 38.2% retracement would have brought us back to around 1206. As you can see, the weeks ending the 27th of May and the 3rd of June basically came back and tagged that level. So from a technical charting point of view, the price of gold is behaving itself quite nicely. Now, if we look at the upside, So in other words, if we look at a retracement of the move that started in August of 2011, which was the peak, and got down to the lows in December, then the resistance levels are at 1377, which also corresponds with some previous price peaks here. And then we've got 1479 and 1581. So there's some price targets over the medium term. And given that we're still below 1300, we've still got plenty of potential upside. And as I've said many, many times, we don't need gold to go to some massive number to do incredibly well out of gold stocks. We just need gold to basically hang around these levels. So if we start getting up in this 1400, possibly even 1500 dollars per ounce level, then you're going to see gold stocks absolutely rocketing higher, because the profits just go up exponentially for gold stocks when gold rises. Now let's take a look at the daily chart. So you can see we had quite a strong reversal on Thursday. We traded up quite high above 1300, turned around on that tragic news in the UK, but then just basically reversed it all on Friday, and that just continues to confirm that there is very strong underlying buying in this market. Yes, we will get some volatility in the very short term to events. It's possible we could get some downside volatility once we know the outcome of the UK vote. But to me, there's absolutely no question about where the trend is going. Let's look at silver. Silver also remaining very strong and not that far off short-term highs. Now, turning to the precious metal stocks, I want to have a look at a couple of stocks. This is GDX. So we've broken out, we got above resistance, we came back, retested that breakout, and we've got another resistance level up here at around 27. Now, I did also note last week there was a couple of gaps, one here and also gaps here that are likely to be filled. So these gaps here were filled on Tuesday and Wednesday, so that then kind of relieves that little bit of technical pressure. It's possible we could end up back down here, but I think the possibility of this actually coming back and completing a normal 38.2% retracement looks to be pretty forlorn now. So I think there's every chance that what we're seeing is a pause that might run on a little bit longer, maybe another few weeks, and then traditionally the second half of the year, very, very strong for gold stocks. Now, I also, just in terms of targets, let's just take a look at the HUI index, because this shows it a little bit more clearly. So this is just another gold index. But let's take a look at this on a big picture view, the retracement of the whole run down from August of 2011. And if we put a Fibonacci scale on that, then it gives us targets on the HUI of a 305, roughly 370. And that 370, which is the 50% retracement, also corresponds to some pretty key support and resistance levels through here. It's almost an exact match. So I think 370 is a pretty good target for HUI in the medium term. Now we're currently sitting at 227, so that's better than another 50% rise here in the major gold indices. So plenty of upside that I think we're looking at in the second half. Turning now to other commodities, copper was flat at 206, which just continues to confirm what everyone is pretty much acknowledging now, and that's we've got pretty weak global economic growth. West Texas crude slightly lower to 48. The supply and demand balance is improving a little bit. However, what you've got to remember is a couple of things. US production from shale oil can come back on virtually overnight. So I think whenever gold's above $50, you're going to have companies out there spiking up their production again and completing wells that have not been completed. So I don't really see that supply-demand balance improving significantly for quite some time, possibly up to 2 years. The other thing that's also occurring is that there is a process underway at the moment of massive write-downs in the value of US assets in the oil and gas industry, because those asset values were established when oil was closer to $100 a barrel. Now with it down at 50, under accounting rules, companies are forced to basically write down the value of those assets. That comes off the bottom line, and could actually be threatening the financial stability of some of these companies. And there is an increasing number of US oil and gas companies that are starting to go bankrupt. So how that plays out, because it then has a spin-off into other sectors and other industries, and the community in general, we'll just have to wait and see. There's the spot copper chart, not much movement there. So overall, to wrap it up, I think there's really little to be done until after next Thursday. I think the impacts either way, I've really had a good think through either a yes or a no vote. And I think the impacts either way are likely to be very short term. They could be quite severe, which we saw in gold on Thursday night. It was trading up at 13.13 and then closed at 12.75. Massive movement in a very, very short space of time. So I think it's likely we could see more of that on Thursday, either way. But in the longer term, I don't think it's going to have too much impact. Definitely not a time to be a hero. You don't want to try and play this market in the very short term, because all you'd be doing is guessing and gambling. And, that's not the way to behave as a trader or an investor. Looking at precious metal stocks, the only approach to me that makes sense is that you hold a core exposure, and we wait and see how things unfold. I wouldn't do anything prior to Thursday. The reason I think a core exposure is still valuable is that if what I talked about earlier, that we basically don't get a correction, that this gold bull market just continues to roll on for the rest of the year. And that's entirely possible. So if you don't hold a core exposure and you continue to sit there and wait for a correction, you may end up sitting there empty-handed. So I think a core exposure with the resilience to sit through some volatility in the short term is just the sensible way to go. So that's it for this week. It's a wonderful time. The opportunities are just fantastic in precious metals, but it will be tricky to play, and that's not only because of the reality of the volatility, but because of our psychology. That's your biggest challenge in these sort of markets. It's how you deal with the ups and downs and the uncertainty and the media and the voices in your head. If you can overcome that, and that's what I work very hard with members to try and help them overcome, then you can do wonderfully well out of what's coming. There's my contact details for those who aren't members, and I'll talk to you next week, and we'll know by then how the UK vote goes. That's it for this week. Cheers.